Ladies and gentlemen, it's our next speaker is a very different kind of a market participant. He's Shiv Sehgal, President and Co-Head for Institutional Equities and Clients at the Edelweiss Global Investment Advisors. He's no stranger to what the FIs are thinking, and it'll be a good idea to have him here and talk to us about FPI behavior and FPI thinking on this very, very critical time that we are going through in Indian markets. Thank you, Mr. Sehgal. Great to see you, and very nice of you to join us here on this Friday afternoon. So if you could tell us a little bit about what's been happening in the markets in the last, say, 45 days or so, especially March, April. We saw this big sell-off, huge plunge, and then a recovery. FIs don't seem to be selling big now, at least from the data from April. That's what it shows us. But what is really happening? I mean, it's not Indian markets alone that have moved up in April. Global markets have also moved. So is it the risk aversion is slowly going away? I mean, what do you think?
Sure. Firstly, thank you everyone for your time and to ET for the invite. I hope all have been safe and continue to be along with your families. Just before I lay down your question and your thoughts, I just want to, for the benefit of the audience, hypothesize that what happened in March was unprecedented. That word's probably been used the most. In my view, the breakout in the equity world has already happened. Right, the bulk of that move happened in March, and I'll as we discuss this, I'll let you know why. But let's be very clear: the deleveraging process, the margin calls, the over leverage from hedge funds, triggered a lot of stop losses, and that all transpired between the second or the third week of March. Right now, we will have, while normalcy has come back into markets because of the stimulus that's been presented by all the central banks, especially in the developed markets. I think it will take time for the real pain in the economy will happen now, right? And while markets have priced in a lot of that carnage already, I think it is going to be a very tough time. And in my prior call to, in mid-April, we had done a call and I mentioned the swiftness in the rally during bear markets can be equally strong. And I think that's what we're witnessing at the moment, right? It's very difficult to kind of time bottom phases. There was, in my view, not only blood on the street in March, that's the term used in the markets, but it was a complete massacre, right? In my view, it also remains a very complex situation. There is no one variable that will be here. As I mentioned, if you look at GFC as a more recent example in 2008, 2009, while the bear market lasted about almost a year, we had 10, 12 very ferocious and velocity-induced rallies that could have been, taken completely out of the woods. And I think, similar to those prior cases, we are still not out of the woods at the moment. Coming back to your question, I think, a disciplined and sequential approach to moving back into risky assets is probably going to be appropriate, as has always been following any sharp market declines. But, doesn't mean that if you're an equity investor, you go back all in. I think most of your panelists and, any esteemed investor in the markets who's been in the markets for a long time will say that a phased manner is probably the most prudent approach. And now let's not forget, the basics of investment rules, which is usual in crisis that investors can be distracted by short-term volatility and a lot of market noise. But in the longer run, it is the strategic allocation that matters along with the tactical shifts that you perceive in your own portfolio. A lot of questions have been asked that, are current Nifty valuations attractive? I think from a relative basis, yes, from where we were a couple of months back, yes, they are. The two important things in the markets that are getting priced in are that one is the forceful bazooka policy responses that we have had. And of course, the forward-looking nature of equities, right? But I generally feel that we are probably entering a very difficult environment in terms of, I would say, for many generations. People who've been in the markets for maybe 30, 40 years, this is the first time globally that we have an economic event of this magnitude, right? It's always been isolated, whether it was wars, during World War II, and even if you go back during the tech boom, it was US-led. The 2008 was a subprime mortgage-led crisis in the US. We have had emerging market crisis, which were Argentina blowing out. But this, for the first time, we have the entire global world kind of shut down mode. We have, roughly 117 countries whose borders have been closed because of lockdowns. That's almost nearly 3 billion people worldwide that are in some sort of coronavirus lockdown. And, historical experiences tells us that, while this too shall pass, the pain in the real economy will probably start. And when I say that, I think there will be, pay cuts, there'll be job losses, and that impact is still to be felt by the economy, even though markets are pricing a lot in. I also, want to, just spend a bit more time on the stimulus that has been announced. Right, we've talked about a lot about, how much the Fed and the ECB and the BOJ have done.
Please go ahead.
So, if you look at it, and I'm having some, let me just, I wanted to prepare some charts, but I'm having some technical issues here. But let me just walk through it, right? Bottom line is, in about 6 weeks, we have had the Fed balance sheet increase by almost $2.7 trillion, right? Or 2.6 is actually the right number. The reality is that's almost equal to India's GDP, right? We had the ECB doing, similar measures. We have BOJ came out, about 2 days back, said that while they had a cap on how much JGBs they would buy, that would be open-ended, which means, they will do whatever it takes. And that's been the ECB, month since 2012. I think in what people are not realizing and what's market factored in over the last, 6-7 weeks is that March will go down in history as perhaps the most simulated single month in the history of capitalism, right? There has never been so much money printed in such a short span of time in capital markets, right? And I think the period that we are going to enter now over the next 1 or 2 months will be that the FOMC, the ECB, and the BOJ, while it will be more of, I think, word of mouth and trying to appease investors and markets, but the actual stimulus measures will probably slow down. They will see the impact of that in terms of, as economies open up in Europe and some of Asian countries as well, they will kind of dictate and see how things play out before we get the next kind of round of stimulus. And I think, as a lot of people have said that, in bear market rallies, S&Ps went down from like 3,500 to almost 2,190. And, we have kind of retraced back in most markets to what, whether it's a 50% retracement or 61.8 in the S&Ps. I think we are also entering a period of, where real economy will take over rather than the stimulus measures, right? But, also one more thing, right? If you look at world equity market caps, right, in March, or the peak was actually in Feb, that was about $90 trillion. Bottom of March, on the 23rd of March, that world equity market caps had come down to almost $60 trillion. So there was a wipeout destruction of $30 trillion that we're talking about, right? While a lot of people, and including a lot of market gurus and panelists will discuss, and as retail people, a lot of people signing in, I just want to spend a few minutes to understanding why the carnage happened in March. And I don't think people understand that well, and I think that will be very informative. Usually what happens is when there's a risk-off event, the stock market goes down, but the bond yields go lower. But because people are invested in bonds, their bond market portfolios actually make a gain. And that's kind of, if you go to any financial advisor across the world, there is an allocation that probably between a 60% equity or a 40% bond portfolio. And you can play that around whether, if as you grow older, you want more in bonds and less in equities and stuff like that. Something similar to what Samir Arora was talking about earlier in the day. What is important at the institutional level, most of the quant funds and relative value funds were also following a similar institutional kind of mix of 60-40. But what they do is that they over-lever their bond portfolios in scenarios like when the market risk sells off, so that while they take pain in their equity markets, the bond portfolio kind of, hedges them in the pain that they're taking in the equity markets. Now, what happened in Feb, when the last week of Feb, the market started selling off, Treasury in the US went from about 1% to 30 basis points, which is normal, right? As I mentioned, equities market sell off, US markets, the Treasury yields go down and you make money in your bond portfolio.
That's right.
Right. But what people don't realize, and this has not been talked about much, to me, from 9th of March till the 23rd of March, something crazy happened in the markets. And the crazy thing that happened was that instead of, while equity markets in the US went from 10% down, 20% down, 30% down, right? And I think the lowest was about 42%, as Shankar also just mentioned. The reality was that between those 2 or 3 weeks, instead of bond yields going from, or treasury yields going from 30 basis points to 0, they actually went in a matter of 2 to 3 weeks back up to 125 basis points. And that completely decimated all the bond portfolios that were actually hedging or had over leveraged with the viewpoint that they will continue to make money in their bond portfolios. And that liquidity event that created the carnage and the destruction in the markets in March, right? Now, because you were not only losing money on equities, you were losing money on bonds. You were basically losing money on your safe assets. Gold was going down. Japanese yen was going down. Most of the currency assets were going down. There was nothing that was spared in bottom line, right? The only thing that made money was cash, because you can't really lose money on cash in that scenario.
Right.
Fed realized that, and if you realize, while they cut rates on 3rd of March, the real stimulus started happening on the 23rd of March. And they've just pumped in enough liquidity in the markets, and they came out and they said, we will not only buy the treasury bonds, they said then we'll buy the high yield bonds as well. And that liquidation and the liquidity that basically the capital markets were in the bond markets were frozen. That opened up the liquidity, and we had a V-shaped bounce in the markets. And all these quant fund and stop losses that had triggered in March, in my view, the volatility spiked. We started seeing some normalcy, and we are back into a real market scenario where people are now actually following, the coronavirus dictatum. And in terms of, so in that peak when Fed was pumping in money, they were pumping in $70 billion a day, right? That is phenomenal. They've scaled that back down as markets have kind of recovered. But, I just thought this interlay of what happened in the markets as to what the Fed did and why they had to do was very important for people to understand as to why the carnage happened. And I don't think, that was kind of formulated in most of the, at least the chats that I hear from people. Now, coming back to the main question, right, which is, and I think everyone listening into this call, sitting at their homes on WhatsApps, we are all following, what is happening in the coronavirus cases. So far, India has been, kind of protected, given that we are in a lockdown. So we don't really know the numbers. I think the question mark will be, as we reopen the economy and people start to work, do we get a wave that takes us back to some of the other economies that, what Spain and Italy and UK and US have faced. I would just summarize that, I don't want to spend too much time on that. I'm not an expert. The optimistic view, there's a lot of chatter that as summer progresses, it will mitigate the virus spread. That's one. Second, the global medical research community might prove surprisingly resourceful in coming up with a solution. I think that, we're seeing more and more anecdotes of that. I think several drugs have shown promise in treating COVID lately, and we'll see more of those, I think, positive developments as the time progresses very soon. Negative pessimistic view is that, a lot of comparisons are done to the 1918 Spanish flu, right? My view is that that Spanish flu was, the second wave was more deadly, yes, no doubt about it. And I've done, a fair bit of studies on that. But my research shows that I think COVID-19 may be less seasonal than the typical influenza virus, which was basically the Spanish virus. So in that way, I think, it might be slightly positive. But, let's not take away from the fact that European economies are slowly reopening now. We will only see the change in behavior from people. And that, to me, that is the biggest question mark and the second black swan event that could polarize equity markets, right? We don't know how consumption will react, by how people will react, how you and me, when we go back into the real world, what kind of spending we will do, in what areas we will do. We all have views, but does that actually formulate into reality is a good question mark. There is also a lot of positive hope from an India perspective that, given our demographics, right? We will not have a demand issue, which I think the US and the developed markets will have. I think you are probably going to enter a very frugal environment in America and Europe, where people will actually save. Whereas in India, I mean, savings have always been kind of on the higher side. And we are still an aspiration society, and that demand will still be there. Our question will be the bottleneck in the supply side, as we are facing with most of the industries shut down. And just to reiterate that the carnage what has happened because of the lockdowns is that just look at while we don't have the data in India, just look at US jobs, right? And I just want to highlight the fact that we have wiped out today. If you look at initial jobless claims in the US, we have wiped out 30 million jobs. And that is more than what jobs US produced over the last decade. We have wiped that out in 2 months, or in reality, actually 6 to 8 weeks. That is a phenomenal number. There is no playbook to come out
Absolutely.
of this kind of carnage, right? Moving on to my thesis, I think I just want to kind of relay into a lot of questions that have been asked on the Indian policy response. You asked those questions earlier in the day to some of the economists as well. India's debt to GDP is a mere 2% versus 9% expected for most EMs. My point is we have announced close to about $30 billion of fiscal stimulus. We need to get to a 10% GDP number, which to me, would be about a 200 to 275 billion of stimulus, which will only take us far with what most of the rest of the economies are doing. And let's not forget that our lockdown has been far more stringent than most of the other economies, even emerging market economies, right? So while the RBI has done enough, and Samir mentioned that as well, I think there is still a lot of stimulus to come, in my view, and I'm hoping that we expect more policy action from the government and the RBI in the ensuing weeks, because the concern is that if they remain behind the curve, as most people are saying, that it will, if you fall behind the curve, you will have to just pump in more and more and more to get you out of a hole. And I think we need to get ahead of the curve, which is what actually happened in the US, and that will really help. The reality is pretty much of every component of aggregate demand is collapsing the world over, right?
Yeah.
The ones who can actually only use balance sheet today to support the economic activity to the level we need in a free fall is, of course, the government and central banks, right? We do need those monetary and fiscal bazookas. In my view, even if fiscal goes to 5% or 6% or 10%, I think the critics and economists will not mind it. This is, as we said, once in a lifetime precedented event, right? And it is an economic shock, and we need to kind of formulate that in our policies as the crisis kind of comes to I think to the fag end of it, and we reopen the economies, right? Coming to my thoughts on asset classes, right? I mean, this is the most genuine question what everyone is kind of dialed into, right? One was what has happened and what's happening with the coronavirus. The question is, what do we do from today onwards?
Right.
And to me, before you answer that question, and irrespectively, everybody is saying today that watch the US markets. They are leading, irrespective of whichever economy you are. Whatever US does overnight transpires into rest of the economies and markets globally. For me, the real question is, what is your view on the US dollar? Does it have a spike off, like a massive blow off because of the dollar shortage? That because of two things. One is we have an oil disaster along with the coronavirus. There's also kind of you have the entire Middle East and economies like Brazil and Russia, which are a lot of oil dependent. So there'll be a dollar shortage from those economies. There'll be a dollar shortage of capital-starved nations like India. So does the US dollar, because of all the printing, kind of go into a deflation zone, or we see a spike off? My view is that if you can answer that question, you will nail your investment philosophy. In the short term, I think there will be a spike in the US dollar because of the dollar shortage created in the world.
Right.
The deflation scenario and the debasement of the currency will play out over a period of time. So what is going to play out is, in my view, you continue to see the US dollar continue to rise up, maybe for the rest of this year, and you probably see the peak in dollar in January or end of 2021, December 2020 or January 2021. And from there on, you see the US dollar tapering off, and because of all the printing that will be required, emerging market economies and currencies kind of taking off, right? That's the view I have. In that scenario, either way, whether USD takes off or not, yes, I saw you asking a couple of questions on gold. I'm super bullish on gold. I think, and let's be, a lot of people ask me, what is the best way to play gold in India? Unfortunately, we don't have that many gold miners to play from an equity perspective. As I speak, Edelweiss is looking to launch a product, and I'm working very closely with this so that retail players can actually have a better alpha and a delta to invest in gold mining companies the world over. And the reason I say that is, see, gold doesn't need to go, it's 1720, 1730 in the US dollar at the moment. Even if gold goes from 20 to 2000 or 3000, it doesn't matter. Gold mining companies today make money at around $900, $1,200 at gold. Their biggest component, oil, is going up anytime soon, right? So that while most of the financial world and consumption companies and any sector will be cutting dividends, and that's already happened in Europe and US, the only kind of will remain gold mining companies. And unfortunately, I prepared a couple of charts, but I'm having some issues. If you look at gold from 2000, right, it has actually been the best performing asset class compared to anything else, right?
Right.
Gold in 1970s has had 2 decades, 2000 and 1970s, when gold had massive kind of overshooting every asset class. In 1970s, gold went up by 15x, right? In 2000, it went up by 5x. My view is that gold in the near term, may only needs to go up 1x, right? And just to give you more statistics, global institutional mandates today have less than 50 bips of gold and gold-related equities in their portfolios. My view is that only needs to go to 1% or 1.5% for gold stocks to have a massive blowout. So that's number one. I don't want to spend too much time on gold. That is to me is a no-brainer at these levels, and there'll be a product coming from Edelweiss that will be, I think, will give you a lot of avenues for people to play that thesis as well. US markets, as I mentioned, a lot of people spoke earlier in the morning. I just want to leave another stat. If you look at the top 5 companies in the US today, Microsoft, Amazon, Apple, Google, and Facebook, they make 22% of the broader index. Guys, that's phenomenal. If you go back to 2000, when the top 5 companies, if you look at that point of time, the peak that they reached was 17.5%. So we are already let's be realistic. Facebook and Google Facebook makes 98% of its revenues from advertising, and Google makes 85% of its revenues from advertising. As corporates take a hit in the US and the real economy takes a hit, marketing for advertising budgets are going to get hit. So I'm not that bullish on the top stocks in the US, the top tech stocks in the long term. Short term, yes, money is flowing in because of also all the algos and passive driven buying. But to me, at some stage, that tapers off. We have had a 20% rally in EMs, right? And that's been on the back of what's happened in the US. As I mentioned earlier, I don't think we are out of the woods. Historically, EM equities bottom out not around policy response, but rather when economic data form the sustainable bottom. To me, we are about at least 3 to 4 quarters away from that forming a bottom. In the next 2 quarters, we are actually going to see the hits, right? The GDP numbers are going to be catastrophic the world over, including emerging markets. I think while markets are forward looking, the reality is that, we don't know how much pain will come, right? So I'm saying there has to be a staggered approach to equity markets, especially in EMs. In the short term, developed markets outperform EMs, but come, 6 months, 9 months down the line, and this is, you have to formulate a longer term view. I think for this decade, and I'm, putting my neck out on the line, I think that 1 or 2 years down the line, emerging markets in 2020s will outperform developed markets in the later stage of this decade, right? Because the growth, the demographics, the numbers are in countries like India, right? And India has got a massive benefit of oil. I don't think oil is going back to 50 or 60 or 70 anytime soon. And we have not had the fiscal response yet. And still, Nifty is back to 10,000. So even if we take pain in the economy, but if the stimulus measures come and the government and the RBI can, provide a transmission mechanism to all the SMEs and NBFCs where large banks are not lending, and that transmission mechanism happens to that actually need that capital. I think we could potentially have a decent bounce back, but then that comes with a lot of caveats. Sorry, I've overshot my time.
No, that's okay. But it's a pretty interesting, very insightful presentation, and some of the points that you made, probably not seen many people make those points. A couple of quick questions which I have. You mentioned about the fiscal stimulus and the thing that the Indian government needs to do, probably about $275 billion or $300 billion is what you spoke about. Now, how do you finance this? Where is the money going to come from? And should we print money? Should we ask for another, RBI Reserves to be transferred to the government? Where is the money?
It's a combination of both, right? We have a lot of FX reserves in the RBI. Maybe some comes from that. We print some. I think let's be fair. The developed market, because it's US in particular. Yes, they are a reserve currency, right? And you ask a very interesting point, and I've said this out loud in a couple of my earlier speeches. USD became a reserve currency in 1920. If you look back from 1400s, an average reserve currency in the world has lasted, the regime has lasted between 75 years to 125 years. In my view, we are entering the last decade of the USD, right?
Correct. Okay.
Of being a reserve currency, right? The problem is there is no other alternative at the moment, right? To the USD. The European Union is in shambles. That could have been an alternative. The Japanese yen is nowhere close to that. China is probably, we have the biggest, let's not forget that probably the first time since Germany in World War II that we have had one country being so much in hatred, right? And that's itself is a big opportunity to India, as a lot of other panelists have said.
Right.
If we can get our political will, an entrepreneurial will, and a manufacturing, the framework right, it can be a great boon to India. We have lost out to China in the last 20, 30, 25 years, right? This is a reset that we have an opportunity as a country to move on, right? Do we have the political will? Do we have the agenda? Do we have, the that these manufacturers need and these companies need? I think that is the key question, right?
Okay, what about digital currency? Currency. So we saw China introduce the electronic version of the renminbi.
Correct.
In 4-5 cities, and I think salaries are also being paid in the digital currency from May onwards. There is a feeling that will now get expanded and it will challenge the supremacy of the dollar. And the dollar will not be so much.
Absolutely. And I think, while India is not kind of, grown up to the Bitcoin phenomena, rest of the world, I think, a lot of people ask me my views on Bitcoin. And my answer is very simple. Bitcoin is the currency of the millennials, right? And the younger generation. You cannot ignore that. The baby boomers in the 1960s and 70s changed how investment world played out over the next 20, 30 years. And you have to give, at least some credence to how millennials are thinking today, and they will take the next 20, 30 years as well.
Right. Absolutely. Okay. And you mentioned about the dollar shortage, and that is one thing that is being hammered about in among the global opinion makers circle. And I think people like Raoul Pal have been writing about how the dollar shortage is going to be the big issue, and that is actually going to lead to more, deflation, and probably the equity risk is going to increase because of that. How do emerging countries handle this issue? Do we have a big problem if the dollar shortage worsens? Our foreign debt is not so much; it's not as high as the other EMs or other countries in the world. So, how does it work?
Absolutely right. So I think India, in that regard, is far better off than rest of emerging markets, right? You have petrodollar emerging markets, which Brazil and Russia, Saudi Arabia, Middle East. I think the Middle East is kind of, in dire straits in the next few months, right?
Absolutely. Yeah.
I think Russia will stand far. Russia, over the last 4 years, did a lot of fiscal prudence, right? I think they are in better standing right now. They can withstand lower oil for a far longer period of time. But coming to your point, I think, yes, India today, because of our dollar debts are not as levered as to rest of the emerging markets, right? To give you more anecdotes, debt in emerging markets today stands at $57 trillion, right? This is all emerging markets globally. That is a phenomenal number, especially when you have dollar shortage, just not in emerging markets, but in developed economies itself. The problem is what's going to happen is all these corporates, right? And shale gas in the US is bust. They can't make money below $30 or $40 oil. And, I think they will need massive bailouts. And as they get kind of bankrupt, the second and third derivative companies who have lent to them, we had Singapore Insurance, Singapore Oil that, had an issue, and that's taken down 3 or 4 derivatives as well, right? That is what I'm talking about. The real pain in the economy is now going to start where, the unknown unknowns of who lent to whom, and that has a default. What repercussions does it have? Even in India, right? I mean, commercial real estate today, yes, people are not paying their rents, but what happens to insurance companies who are, getting the force majeure getting in place there? There are a lot of unknowns, known unknowns, as Howard Marks says, right, that are coming into markets, and we can't factor in. There is no one variable that has the right answer.
No, absolutely. That's true. So a couple of quick points, Shiv, before we wrap up. Some questions from our viewers and audience. Arvind Rana from Bulandshahr, he wants to know which of the sectors hit most by the COVID-19. And RBI Sehgal of Faridabad also has a similar point about outlook for auto and the aviation sectors.
So guys, it's a no-brainer that those sectors, the cash flow where today it is zero. Your malls, your airlines, your tourism, your resorts, right? And I can name all of them. Maruti just reported in the morning, zero sales for March.
Absolutely.
For April, sorry. But the reality is that, before you answer that question, which sectors will be hit the most, I'm again reiterating the key question is, as we open up the economy, and that still remains a question mark in places like Maharashtra, whether it's mid-May or end May or first week of June, I have no answer, right?
Yeah.
What happens when we actually return, right? Will we go back? What kind of utilization levels will we go back? What kind of demand will be there, right? Those are the main critical questions. And to be honest, nobody has the right answers. What you can do is have a framework around it and ask the right questions, which you are, right? And figure out as I think Samir or Shankar said that, it's a movie you're watching and you form the pieces as data comes along. At the moment, I don't have the data to answer which.
That's right. That's right.
Because I don't know whether it's 2 weeks or 3 weeks or 4 weeks, right? And even when they open, what kind of demand will have yet? But yes, there are a lot of companies that will benefit from this, including data companies, right? We are all sitting at home and, a lot of people are watching Amazon or Netflix or, this webinar has been going on for 4 hours. People are using data. That is the sector that's, work from home is going to be a reality, right?
Absolutely.
So companies will benefit from that. Online learning, education, new skills. That's the kind of questions you will formulate your thesis around and play it.
Yeah, that's true. So thank you very much, Shiv. That's a very enlightening, very enriching presentation. And let me also remind our viewers that the presentations will be available on etmarkets.com, or you can shoot a question to us. And if you have anything to ask Shiv, and Shiv can always get back to us. That's not a problem. Thank you, Shiv. Thank you very much for your really insightful presentation.
Thank you so much. Thanks to everyone for dialing in. And I had prepared a presentation which I'll make available. There are some interesting charts in there. If anybody has any questions, please feel back and stay safe and stay happy and positive. Thank you.
Yeah, stay safe as well, Shiv. Thank you very much. Thank you. Thanks a lot.